don't get invited to be on boards if you belch too often at the dinner
Well,
table.
Blue Chip Stamps, we had a director who said, I don't see why you guys should be so important just because you own all the shares.
Yeah, we and Rick Aaron owned what percent probably?
Yeah, 50%.
Yeah, 50%, and they'd appointed all the.
They're all members of the Rotary Club.
It came out of a government settlement or something, and it was not an ideal form of decision making. And they just had a different calculus in their mind that we didn't, and I can understand it, but I'm not going to replicate it.
When it gets to so-called best corporate practices, I think the people who talk about them don't really know what the best practices are. They just know what they think are the best practices. And they determine that based on what will sell, not what will work. And so I like our way of doing things better than theirs, and I hope to God we never follow their best practices.
Yeah. I'd like to point out one thing on independent directors. I mean, I've been on 20 public company corporate boards, not Berkshire or its subsidiaries. So I've seen a lot of corporate boards operate, and the independent directors, in many cases, are the least independent. I mean, if the income you receive as a corporate director, which typically may be around $250,000 a year now, if that's an important part of your income, and you hope that some other corporation calls the CEO and says, how's so-and-so as a director, and the current CEO, your CEO says, oh, he's fine, never raises any problems. And then you get on another board at $250,000, and that's an important part. How in the world is that independent? I mean, I really, just on observation, I can't recall particularly any independent director where their income was from the board was important to them. I can't recall them ever doing anything in board meetings or committee meetings that actually was counter to the interests. They put them on the comp committee. I mean, they're just not going to upset the apple cart because what they're, and I'd probably behave the same way in the same position. I mean, if $250,000 a year is important to you, why in the hell would you behave in a way that's going to cause your CEO to say to the next CEO, say, this guy acts up a little bit too much, you really better get somebody else. It's the way it works, but they've got these
I think it's a little worse than Warren's telling you.
Yeah, Charlie and
it's really awful.
It was awful. I mean,
and Warren and I we occupy the niche for pomposity very well ourselves. We don't need any more of it.
Charlie and I were on one board. Well, I was on one board, actually, a long time ago, where we owned a very significant percentage of the company. And the rest of the board was almost exclusively customers of the company, but not owners. They had absolutely token holdings. And at one point, we were looking at something where a tax decision was being made in terms of a distribution of some securities. And it was a lot of money was involved. And one of the other directors said, well, let's just swallow the tax. Well, his swallowing amounted to about $15 or something, or some amount of And I said, let's parse this sentence out. Let's swallow the tax. Let us swallow the tax. So who wants to swallow an equal amount to, to me? You don't.
Well, we've discussed Dexter many times in the annual report, where back in the mid-1990s, I looked at a shoe business in Dexter, Maine, and decided to pay $400 or so million for something that was destined to go to zero in a few years, and I didn't figure that out. And then on top of that, I gave the purchase price in stock, and I guess that stock could be worth, I don't know, maybe 6 or 7 billion now. It makes me feel better when the stock goes down because the stupidity gets reduced. Nobody misled me on that in any way. I just looked at it and came up with the wrong answer. But I would say almost any time we've issued shares, it's been a mistake. Wouldn't you say that, Charlie?
Of course.
Yeah.
We don't do it much anymore.
No. So if I were investing in China or any place else, India, UK, Germany, I would apply exactly the same sort of principles that I learned from the intelligent investor. I would think of stocks as a small piece of a business. I would think of investment fluctuations being there to benefit me rather than to hurt me. And I would try to focus my attention on businesses that where I thought I understood the competitive advantage they had and what they would look like in 5 or 10 years. So I don't think I would change the principles.
With the internet, I think we're seeing a change that has not been seen in the last 500 years. As humans, we haven't seen something that is as dramatic and as profound that's going to come upon us.
The internet will have a huge impact on the world, but I'm not so sure that makes it an easy investment decision. Charlie?
Well, at least it's not an easy investment decision for us, and that's what we're looking for.
Yeah. We will never turn our money over to somebody else. If we're going to lose your money as Berkshire shareholders, we're going to lose it ourselves, and we're going to come back and look you in the eye and tell you how we lost it. We are not going to say this game is too tough. The key to Graham's approach to investing is not thinking of stocks as stocks or part of a stock market. Stocks are part of a business. People in this room own a piece of a business. If the business does well, they're going to do all right as long as they don't pay way too much to join into that business. So we're thinking about business risk. Now, business risk can arise in various ways. It can arise from the capital structure when somebody sticks a ton of debt into some business, and so that if there's a hiccup in the business, that the lenders foreclose. It can come about just by the nature of the business. Certain businesses are just very risky. Back in when there were more commercial aircraft manufacturers, Charlie and I would think of making a commercial airplane, a big airliner, sort of as a bet your company risk, because you would shove hundreds and hundreds of millions of dollars out into the pot before you really had customers. And then if you had a problem with the plane, the company could go. There's certain businesses that inherently, because of long lead times, because of heavy capital investment, that basically have a lot of risk. And commodity businesses have risk unless you're the low-cost producer, because the low-cost producer can put you out of business. Our textile business was not the low-cost producer, and we had a fine management, and everybody worked hard. We had cooperative unions, all kinds of things, but we weren't the low-cost producer, so it was a risky business. The guy who could sell it cheaper than we could made it risky for us. So there's a lot of ways businesses can be risky. We tend to go into businesses that inherently are low risk and are capitalized in a way that low risk of the business is transformed into a low risk for the enterprise. The risk beyond that is that even though you identify such businesses, that you pay too much for them. That risk is usually a risk of time rather than loss of principal, unless you get into a really extravagant situation. But then the risk becomes the risk of you yourself. I mean, whether you can read your belief in the real fundamentals of the business and not get too concerned about the stock market. The stock market is there to serve you and not to instruct you, and that's a key to owning a good business and getting rid of the risk that would otherwise exist in the market. You mentioned volatility. It doesn't make any difference to us whether the volatility of the stock market is that averages 0.5% a day or 0.25% of a day or 5% a day. In fact, we'd make a lot more money if volatility was higher, because it would create more mistakes in the market. So volatility is a huge plus to the real investor. Ben Graham used the example of Mr. Market, which is we've used it. I've copied it in the report. I copied from all the good writers. And Ben said, just imagine that when you buy a stock that in effect, you've bought into a business where you have this obliging partner
who comes around every day and offers you a price at which you'll either buy or sell, and the price is identical. And no one ever gets that in a private business where daily you get a buy sell offer by a party. But in the stock market you get it. That's a huge advantage. It's a bigger advantage if this partner of yours is a heavy drinking manic depressive. I mean, the crazier he is, the more money you're going to make. So as an investor, you love volatility. Not if you're on margin, but if you're an investor, you aren't on margin. And if you're an investor, you love the idea of wild swings because it means more things are going to get mispriced. Actually, volatility in recent years has dampened from what it used to be. It looks bigger because people think in terms of Dow points, so they see these big numbers about plus 50 or minus 50 or something. But volatility was much higher many years ago than it is now, and you had the amplitude of the swings was really wild, and that gave you more opportunity. Charlie?
Well, it got to be the occasion in corporate finance departments of universities where they developed a notion of risk-adjusted returns. And my best advice to all of you would be to totally ignore this development. Risk had a very good colloquial meaning a substantial chance that something would go horribly wrong. And the finance professors sort of got volatility mixed up with a lot of foolish mathematics. And to me, it's less rational than what we do. And I don't think we're going to change.
Yeah, well, the finance department sees that volatility equals risk. Now they want to measure risk, and they don't know any other way. They don't know how to do it, basically. And so they say that volatility measures risk, and